All right, y'all. Without further ado, let's dive into some really interesting insurance talk here. My name is Charity Kuohivinui, and I am the host to host executive assistant. I'm really excited to be able to present a panel of experts to talk with you today about how you can best navigate the changing world of insurance and protect your business, your family, your home, your future. They're going to give us some valuable insights because we do have a panel of three folks I'm going to introduce in just a second. What I would like to do is ask you to sort of hold your questions until we kind of break for Q&A, or if you could put your question into the chat and we'll start to sort of curate and collect those as we go, just so that we can give everyone a chance on the panel to present their point of view and kind of hear from everybody on these topics, which just might spark more questions from you. So definitely gather those. Like I said, enter them into the chat or wait until we break for Q&A. So I'm really excited today because we have a super compelling amount of coverage, I guess is what I'm trying to say, which is appropriate for insurance here, between the folks on the panel, essentially. So what we have is first representation from Country Financial, and this is Jeff Dorn. Jeff, you want to wave your hand a little bit there? So Jeff handles, well, I'll let you talk to me about Country Financial real quick and do a brief introduction.
Oh, brief introduction. My name is Jeff Dorn. I'm a financial advisor and insurance agent. I've been with Country Financial for just under 18 years, and Country Financial is having its 100th year right now, this year. We do mostly family and small business insurance, and I've been involved with host to host kind of since early on because we were one of the few companies that had we could write Airbnb exposure on a typical home insurance policy.
Yeah, definitely. I was actually a customer for a while, I believe. So thank you for all your help with that and for that introduction. Sure. Moving on to more of traditional coverage, some home and business coverage, and then we have representation from a slightly different focus, which is Jeff Greco with Steadily. So why don't you tell us a little bit about that and your background?
Perfect. Yes, I'm Jeff Greco. I am the lead actuary at Steadily. I'm a fellow of the Casualty Actuarial Society. And at Steadily, we are focused on basically property insurance targeted towards landlords, but really we cover the duration gamut for rentals. So we will insure the long-term rentals, like the typical year long, but we also do short-term rentals and those midterm, whether they're 30, 60, 90 days as well. And that's our bread and butter. That's what we focus on. Steadily has been around for about 4 years now, a little bit longer than that. And we're growing rapidly and available countrywide.
Interesting. Cool. Thank you. And now I want to turn it over to our friend Nick Massey with Proper Insurance. And Proper Insurance has been a longtime supporter of Host to Host. And we've heard a lot from him. I know we can't wait to hear a lot more. So let's, without further ado, Nick, give us a little bit of information about you and Proper.
Yeah. Hi, everybody. Thanks for always having us back. Always happy to participate and be part of Host to Host. So for those of you who don't know me, I am Nick Massey with Proper Insurance. I've been with Proper specifically. I just entered my 9th year with Proper. For those of you who have been around Host to Host and have seen me talk a lot, I am now the Chief Sales Officer. Hasn't changed what I do and my duties here. I just now have a fancy title behind it. Always happy to be here. For those, again, if you don't know who Proper is, we solely specialize in short-term and mid-term rentals, whether it is your primary house doubling as or a second home. We are able to write that as well as multifamily risk that has short-term and midterm rental exposure in it as well. We are the first and foremost insurance policy built from the ground up specific for that space and the only access point in the Lloyd's of London market for this type of product that we have put together. So we continue to be proud to have those endorsements and share in our knowledge for the host-to-host communities and all the communities across the country who are struggling with this these insurance equations and regulations and you name it. We're here to support and stand behind you in the fight.
Yeah, and there really is a lot going on right now in the world of insurance, to say the least. And that's part of the reason we were so excited to be able to host a panel like you guys to really explore kind of where we are now and where you think we might be going, right? For the future. So there's been a lot of unease in that area, especially with some of the policies canceled in California and some of the impact of the big windstorms we've had in the Pacific Northwest that can really cause destruction. So I guess I'll just open it up with a broad question to the panel and feel free to, chime in. You don't have to raise your hand or anything, just jump in. It's real casual here. But tell us how you think that climate change is really affecting the insurability of short-term rental properties. Are there any specific things that our hosts should be kind of concerned about with regards to that? Are risks increasing for hosts? Tell us what you think about this sort of changing landscape.
Well, in our realm, right, we identify everything, especially rate wise. It's a market base, right? So we're not coming in and taking the stuff that's happening in Florida and applying it to rates in Texas or California or the Gulf or in Montana or in Oregon, right? It's all based on an individual thing. It's with no question that storms are getting significantly worse, winds are getting significantly stronger, fires are burning more rapidly, hotter and faster, and in areas that we're not used to seeing in the past. The Appalachia being a key component of this is now turning in, this is their fire season right now. And so with our internal underwriting have been very diligent and we have to protect the book of business. That's what underwriters and actuaries work towards. And so, yes, as a short-term rental host, I think the biggest thing is it's not so much that your property might be declined because of climate change. It's more that your property may no longer fit a program because lack of address locally in certain things. So it could be reducing hazardous fuels in a more rural community for forest fire things, in areas prone to windstorms like hurricanes and things like that. It's partly an issue of stop building multi-million-dollar single-family homes right on the beach because they're going to get wiped out. They're going to be a multi-million-dollar loss to the insurance company, and then who gets to pay the bill? It's distributed across everybody. I think developments and new developers also need to be conscious of the insurance equation in the building of new homes. As we continue in the west area, so I'm in Bozeman, Montana. I am no stranger to forest fires in the summer. I live in it from June to September. We have got to stop pushing developments up into the forests. We have got to stop pushing developments into the very bottom of the mountains because that is where these damages and these big fire losses end up happening. So what do? We just stop writing the business, unfortunately. You just can't get insurance. So it makes it difficult, especially for the modern property investor who's expanding, right? If you're going to expand your portfolio before you lock in a purchase, you need to check with a handful of different insurance providers on if they're even going to write it or not.
I'll jump in. I would add to that. If you're in Portland, Oregon, the only way this is really going to impact you is rate. Cost of everything is going up. It's greatly impacted construction costs, construction materials, building costs. For the last 3 or 4 years, every dollar an insurance company took in, they would pay out $1.05 in claims. So that's why rates are going up. Rates are going up. You could say 20, let's just say 25% on home, plus or minus 10%, depending on the characteristics of your home, age of your home, things like that. So this really is going to impact, as Nick was saying, this is going to impact people buying houses, not in towns, but typically someplace where there's a forest. Like I'm here on Mount Hood right now. I wouldn't buy a house on Mount Hood personally. A lot of carriers won't write it if there's a tree within 100 feet of your house. So if you came to the forest to be in the forest, you're going to have to chop down the forest to get insurance. And
Yeah.
what I think is happening is that a lot of carriers are having these strict requirements, and it's pushing people to just a few carriers who are writing business. And so what's going to happen is you're going to get an overconcentration of risk with those few carriers, and then those carriers are going to wake up and cancel everybody, and then that's when the problem's going to arise. So personally, I'd be very cautious about buying a property in a forested area. But if you live in downtown Portland, you're just going to face rate increase, and that's it. And we're probably through the lion's share of that. Maybe tariffs and things like that will come back and put us through a second wave of that. But we've gone through it, and we've come out the other side. Hopefully, going forward, rate increases won't be that much more than the cost of inflation. But as I say, if tariffs throw a monkey wrench in that could change everything. But we've written Airbnb risk for as long as you've known me, for as long as this group's been around. It hasn't been a problem. I don't see it being a problem at all. So the only other thing I would say actually is a multi-unit apartment, multi-unit condo. Insurance companies are losing money on those too. So those are less desirable for insurers and more expensive. But your regular home ADU situation, not a problem.
Yeah, I agree. I'll jump in real quick also. I
Yeah.
agree with everything Nick and Jeff have mentioned as well. A big thing that I would say is to Jeff's point, exposure management for the insurers is critical in making sure that they're not overexposed to any particular region or area, in case an event happens that has an outside impact on their book. So Jeff's example, if there was overexposure on Mount Hood, for example. So that could play a role in the availability of insurance as well. To his point, if there's only a few carriers writing in a certain area,
Mm-hmm.
they're going to run out of capacity that they can offer probably pretty quickly. And that puts more strain on the supply and demand.
I see. Interesting. All these different characteristics that come into play, right? Is it a city? Is it a mountain? Is it a forest? Is it on the beach? Is it obviously all of these are factors that underwriters and are kind of considering when they're looking at whether they can continue to write insurance policies for that place, or whether they can, like Nick said, if they're even going to be able to offer coverage in that location, or if, as Jeff mentioned, their rates are going to have to go up 20% to offset additional increases and things like that. And then one thing I think Jeff Dorn might have mentioned was how the characteristics of the home, like the different characteristics of the home, can also impact the rate increase that someone in, say, a Portland or metropolitan area might experience as someone who has, sharing a part of their home with guests, like many of our members do. So the specific question, I guess, that I kind of have related to that is, are there any like characteristics of the home that a short-term rental host, or even just any homeowner really, can do to make their property more insurable, to reduce premium costs, especially, if they're experiencing these, 20% increases that are less sustainable for many folks these days?
If that's directed to me, I would say in general, no. If you were going to buy a property specifically to turn it into a short-term rental, newer is cheaper. So a 2024 house instead of a 1924 house is going to be cheaper to insure. You can imagine why less things are going to go wrong. Materials are newer, standards are safer, higher, all that kind of stuff. But if things as far as a homeowner can do, I don't think nothing comes to mind except, you could reduce risk. You're not necessarily going to reduce premium. If you have an old house that doesn't require a handrail because it's not code when it was built, but you put one in, that'll probably save you money in a claim situation, but it's not going to change the premium. So I would say in short, no. I can't think of something you could do that's really going to drop your risk.
Interesting.
Yeah, I mean, unless you, if not required by code, but you decide to spend the upfront investment to put in a fire suppression system, right? Depending on the carrier, that credit can save you 10 to 15%, right? But are you going to go and spend 25, 30, $50,000 to put in a fire suppression system to save a couple $100 a year on your premium? Probably not. Right. And so to kind of echo Jeff Dorn, when you look at newer homes and newer building codes, that is an actuarial variable that's put into rates, right? And so when you look at the defensibility of a property, especially in the short-term rental field, right? Like if you have ever done any work with proper insurance, I don't care if it was built in 1905 or 2005, you're putting a handrail on those stairs because if you're staring down the barrel of $1 million lawsuit, I need to be able to defend you, and a handrail is a great way to do that. But so we're baking that ourselves into the rate on our underwriting requirements already. But again, there's really nothing you can do other than raise deductibles, lower limits to adjust your premium rating if you're in that spot.
Yeah, I'll add, I agree there's little that can be done to offset premiums from that perspective outside of what Nick just mentioned in raising deductibles and lowering limits. But the one thing maybe that could be the difference between a carrier offering a policy or just not offering at all might be making sure, if we're talking about wildfire, forest fire type of risk, making sure that the defensible area is clear of brush. There's not that the potential lawn area is maintained and built in a way that will make it potentially withstand better in wildfire. That's something that we at Steadily review when we're assessing risk in wildfire prone areas, and goes into a score that we get from a different vendor as well. So all of these things play into the ultimate will and policy actually be offered and bound.
Yeah, it's kind of, I don't know, I think it's related, but one of the things that you said just struck me about the clearing the brush around the home in a wildfire susceptible area. Sounds obvious how Jeff was saying if you've got a tree within or the other Jeff, sorry, Jeff Dorn. Jeff Dorn was saying if you have a tree within 100 feet, that could be a problem, right, for getting coverage. And I think like, wow, I know that's super fascinating. And it harkened back in my mind because I have roots in Hawaii. And the Maui fire was something that really struck me. There was like one home that was standing, and it was the home that did not have brush within like 6 feet surrounding the home because the fire just never jumped to the home, I guess. And so it feels like something such a small thing that can have such a significant impact, I guess was my takeaway from that. So
yeah, I think like a big thing that with the three of us on this side of the insurance sphere, like insurance just gets a bad rap anyways. And it's the industry we decided to pursue. So we have to take it. But actuaries and actuarial data is rarely wrong. So when you look at 3 years ago, when State Farm was trying to adjust their rating structure because they had modeled the data to see that this increased potential for fire risk with the drought they're going through and the increase of the winds and the shifting of jet streams and everything, they had pre-planned almost 3 years ago, knowing that something bad was probably going to happen in that area, and they were declined rate increases. So what do? We're going to propose that we pull out of this. And they were given 24 months to make that transition. And it just so happens that 24-month end date was 3 months prior to these fires starting. So there is some lessons to be learned in the fact that, as much as the insurance world can get a bad rap, that this modeling and this data is rarely incorrect. And it's been going on since the late 1600s. Folks in Jeff Greco's positions are not naive to what needs to happen to make sure a product can remain in existence. If we don't model our stuff correctly at proper insurance, we're out of business. We're gone. You can no longer attain this product anywhere in the marketplace because we did it incorrectly. So, we don't like raising rates. We don't like telling our clients that rates are going up, but it's what needs to happen to ensure the future success of being able to attain the type of coverage you want to obtain.
So true. And that kind of leads to another question, because, and it's not that we're pitting anyone against anyone in any way, but the job of the insurance company is to remain in business and to price things accurately so that if they do have losses, they're able to pay those out to the people who have been paying premium for this, and then also still remain financially viable, right? Like all those things are important. And there's, as we know, gears like in insurance that we can pull, right? You can increase your deductible, decrease your coverage. But sometimes what that can do is leave people vulnerable because they're not really adequately being covered for potential losses that might be significant. And but to drive down the cost, maybe they've cut this or that, and it kind of happens on both sides. I think in some ways insurance companies make changes to policies to reduce coverage to make sure that you can continue to be financially viable at the same time, and the homeowners may not always be aware of what changes have happened behind the scenes to kind of create this gap where they're not fully protected where they maybe thought they were. And sometimes, like I said, they're making the choice to make the gap happen and kind of doing it to themselves. So what I think I'm asking is, can you shed some light on some of the biggest ways that a homeowner or a host might not be as protected as they might think they are, or like some gaps that might be in policies, something that people can be aware of that they should go back to kind of check their policy and make sure that they've got it, at least understand what their coverage levels are?
I think water damage sublimits is the biggest thing we've seen be put in across the board. And having knowledge of both Jeff's here and the companies that they work for, there's options to, okay, if you're willing to reduce the risk to the insurance provider to lower your water damage, to have a sublimit on water damage, let's say, well, you pay less in premium. Because the basic equations of premiums is risk transfer. The more risk you transfer onto the carrier, the more you pay in premium, and vice versa the other way around. But I think as these insurance providers are trying to find ways to try and solve two problems, they create some more problems due to lack of transparency to the consumer. And so that is one, okay, we're gonna do these sublimits, we're gonna make these changes, maybe we strip this coverage and do that. And they send you a letter in the mail and you look at it and it says, review these carefully, and you fold it back up and put it back on your desk because you're like, I'm not reading all of this. Totally get it. They did what they have to do at a minimum to notify you. But I think people are kind of missing the point in, if your insurance premium hasn't gone up, or maybe you talk to your agent and they're like, I can save you some money here. The next big question it asks is, I need to fully understand what has been adjusted and changed so that I know what type of risk I am taking. And Diana, great question. Thanks for putting that out because I get stuck in my own head on insurance jargon. Sublimits mean, so you have your basic limits of insurance, and let's just simple numbers. I got $1 million on my building. I have $100,000 on my personal property or furniture, and let's say I have another $100,000 on income or rental protection for my revenue. If I have a sublimit for water damage of say $25,000, then I only get $25,000 in protection, right? So if I have a $50,000 water damage claim, I'm not getting 50. I'm self-insuring the excess above that 25 grand. And what my trade-off here is I pay a little bit less in premium than my neighbor, right? And so we started to see a lot more of that. And there's options, right? You can say give me a sublimit on water damage. I'm happy to pay that to take care of that myself, or remove this or remove that from my coverage offering. But you need to understand what you're giving up before you make that decision.
Yeah, a similar example along those lines, Nick, and maybe not as applicable in Oregon as maybe the Midwest, the more hail prone states, but um, pretty much industry standard from what I've seen for roofs is the valuation of the roof replacement will change based on how old the roof is.
Mm.
So let's say your roof is 10 years old when you first insure your building, after a couple renewals, maybe now you're beyond the age of roof and that valuation might automatically change. And you may not see that if you're not reviewing the policy work when it's sent to you at renewal time and things like that. So that could be a coverage gap that could pop up. Um, I'm sure there's other instances as well, but that's the one that jumped in top of mind.
I
Yeah,
think the
that's a big
big
one.
one, I think for me, the biggest one is the pile of money available to rebuild your house if it's a total loss, like a fire. Is that pile of money big enough? And the only way you're going to know that is if you talk to your agent and have them tell you how they came up with that number. And I see a lot of people who just pull the number. They use the swag method, which is the stupid wild ass guess, and they just call it good. And if it's not good enough, then that's going to be your problem come claim day. So you need to talk with an, in my opinion, you need to talk with an agent who will take you through how did they come up with that number and is it enough? And if it hasn't gone up by, I don't know, let's say 10, 15% the last few years, probably not enough. So that would be my first call. The second thing I would say is I would talk to the agent and say, what do you have on your policy for yourself? And tell me why you have that and see what they have.
Oh, that's a good
Because they may have
question.
coverages that they haven't even offered you because most people don't want to pay for it, but they have it because they don't want to take the risk. So that's kind of another rule of thumb I would use. But have those conversations. And they can use stories to explain how things work too. Like if you have an Airbnb rental and there's a kitchen fire and you can't use the kitchen, are they going to cover that lost income? For how long? Those kind of questions. So I
Yeah.
would talk to somebody. Talk to somebody, ask them hard questions.
Yeah, and like in what kind of how do they view it? Like I'm starting to see some of these policies come back where they say they cover your lost rental income, but only at 80%. Right. And so that's how an insurance company is trying to reduce their risk to manage rate. Do they pay top gross line revenue? Do they pay fair market value? So there's a lot of those questions. This is a very good point, Jeff.
Yeah, and loss of use of the space is a big deal, but you don't really think about it until it happens, right? So all of a sudden you've got, a flood, water damage in your space, and actually you're out for a month at least until you can get it repaired and get back online and everything. And it feels like as a host, that's obviously income that you're sort of counting on already. And a lot of times I feel like the policies don't cover that. I guess my question is like, is business like liability or loss of use of the space, loss of income, essentially, covered in the same way for hosts as it would be like for a traditional business insurance policy, I guess. How's that work?
Depends on what policy you're buying. Right. So you gotta be mindful and back to Jeff, circle back to what Jeff was just saying. You gotta ask these questions and fully understand. One thing I always promote when I'm doing a podcast or I'm at a conference and I'm talking live to people is like you need to spend more than 10 minutes when you're in this industry of short-term and mid-term rentals to understand how your coverage works. So, there's confusion. Loss of use does not pay loss of rental income. Loss of use pays you charity to go live in a new home while your property is uninhabitable. Right. And so if you just have loss of use and you don't have the right endorsements or enhancements to change that language over to loss of rent, you have the wrong coverage. It's the wrong policy, and it's really time to dive in and try to find the right one. You will have loss of use if it doubles as your primary residence. 100%, you need to have that. And if you short-term rent, you got to make sure you have that enhancement that you can use that loss of use as income or fair market rental value. But in the sense of mitigating risk on this panel and our topic here, mitigating risk and what's going on in the insurance world, I think the big thing is is you need to identify what your personal risk is financially if the property shuts down. Are you in a position where you can cover the carry cost without the rental income for 12 months? If you are, great. Don't really get too hung up on the details of how much limit of insurance you need to have. Because you're in a position, if the property shuts down, you can probably forego paying additional premium and definitely have the conversation with the agent and make this decision yourself. But you can maybe forego some of that income. If you're in the position where you can't cover the carry costs for more than 60 days, you need to make sure you're insuring yourself very well and paying that extra money to ensure that your mortgage, your insurance premium, your utilities, everything is being paid. Number one claim in insurance is water damage, and the typical shutdown period for that is 45 to 90 days. So you need to make sure you're at least covering that. It's going to cost you a lot more money and a lot more headache if you go into that. If you're in that position and you can't carry the cost of the property for more than 90 days, you really need to be paying more in insurance premium to protect yourself financially there, because it's going to cost you more money in the long run if you can't pay the mortgage, unfortunately. Right. So that is a big talking point, especially in our office. It's like, we'll focus on guest damage. We'll focus on your furniture and your lovely couch, but I'd rather spend time talking about your income and how you need to be protected there in the unfortunate situation you get shut down.
Interesting.
And I'll just add to that, Nick. I love that point, but there's the other side of the coin also that maybe from your perspective that you mentioned, where if you do have enough to cover those carried costs for 12 months, it might make more sense if you're looking to acquire additional short-term rental properties. Maybe you want to pay that additional coverage to make sure you're covered from an insurance perspective, but that allows you to acquire additional properties. That's the algebra that's different for every single person based on their situation. And again, to Nick and Jeff Dorn's points, I would stress talk to your agent, figure out what you want, the approach you want to go to, and see what fits best for you.
And then I guess if, we've been talking about if disaster does strike and these things do happen and kind of we all have to be prepared for them. But do you have some words of guidance or advice or best practice, tips, tricks, that kind of thing to help people be as prepared as they can? Like I think I saw where somebody was like, it was about the California fires, and it was like, hey, before you evacuate your house, you better go right then, run around and take video of your, everything that you've got in your house, because it's going to make the claims process so much easier. And you're not going to have to, you'll have video evidence of these items that you had in your home. Is there anything to that? Is there any tips or guidance you can give to people so that they can have the best outcome?
I think first things first, safety first is the first thing. So if safety is ever a question, you get to safety before you take pictures or videos of anything.
Yeah.
Yeah. If you have specialty items, you should have them scheduled or notated down so that you can replace them for sure. In my side of the thing, the beauty of short-term and mid-term rentals is that you have an online listing that shows what is in your house. And like, maybe I don't know what exact model of Keurig you have, but I know you have a Keurig and I know you have a limit of insurance. Go buy yourself a new Keurig because I can see it in the picture, right? On the personal side, my parents had a house fire in 2018. And dealing with insurance claims is never fun. They have Chubb insurance. Chubb is regarded as one of the best, but they handle claims the same as everybody else. You have a contract. My mom had custom made furniture from a local furniture maker here who does one of a kind. It's one off. You go and tell them what you want and they make it. They don't mass produce. And Chubb insurance gave them $250 to go buy a new couch. So you got to go buy the new couch because of depreciated value, and then you get your replacement cost after that. So you go get the new $5,000 couch. Okay, you got $250, appreciated value. It's like a 12-year-old couch. That's how it works. And then you go and get supplementary payments. So it's not so much a sense of like you got to take a picture of every knife and fork. It's not bad to have inventory of what's in your property, but insurance companies are for the most part not going to fight you on it.
I'll add to that from the catastrophe perspective. So wildfire, tornado, hurricane, whatever it might be. Uh, that's a very stressful situation. I just want to say that up front. But something that can usually be very, very helpful is to submit your claim as quickly as possible. And the reason that's helpful is then the insurance company can get an adjuster out there. And for example, if a hurricane rolls through and it blows your roof off of your home, well, it takes a while to rebuild the roof. So the faster you get that started, or at least get it mitigated, covered, you're preventing subsequent rainfalls from damaging the interior of the home.
Okay.
So that's an example where getting somebody out quickly to assess the damage and get mitigations in place can prevent subsequent further damage from happening and really help both making you whole again and also helping the insurance company reduce the overall cost from the claim. So it's helpful on both sides.
Yeah, I could see that for sure.
I would just add that taking a video of your stuff, that's not for the insurance company. That's for you to remember all your stuff.
Oh,
So if you went through and just filmed all the drawers and all your closets, you would know. So when you have to make this list of what you lost and submit it, you have that refreshed. And as far as claims go, the first thing, the main thing you should know about a claim is if you have a water claim, you need to get a dehumidifier in that place as quickly as possible. That's the only thing you need to know. Um, Claims go wrong when people delay that, or they think they can save money and turn on the heat and vent the house. No, go get somebody to mitigate that water damage as soon as possible, and get somebody with dehumidifiers in your space. And if they can't get them, go to Home Depot and buy them yourself. The insurance company will compensate you or not hold you liable for things you do to try and mitigate risk. So
huh.
if you have a house fire and you drag your couch out on the front porch to save it, and a rainstorm comes to get your couch wet, it's going to be covered. So
Huh.
and yeah, unless you're with some off-brand insurance company that's no good, you're going to be taken care of. I wouldn't worry about it.
Interesting. Do you recommend having an household inventory
No,
at all? No?
no, I don't.
Okay.
I don't. That'd be torture. Why would you ever want to go through that? Unless you had to.
All
Unless you're
right.
getting paid, literally paid to do it, I wouldn't do it.
Well, you might for short-term rentals, right? Because the vacancy is turning over so frequently. So if you already have it, that's great. But that kind of goes to Nick's point that there's likely already a listing where most of the items are visible. So to Jeff Dorn's point, I don't know if it's that much of a value add.
Interesting. 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 Well, I don't want to hog all of the good questions. So if anybody else who's listening has anything that's come up that you would like to ask our panel while we have them on the call, I'd love to turn that over to you. Feel free to drop it in the chat or to just start talking. We're here.
Jeff, I have a question. Jeff Dawn. I own a couple of properties in Mount Hood. Have done for 10 years. How do they decide which policies is it, in terms of the age of the property, decide on who they drop rather, age of property, what factors would play into that? Or would they just drop
You
the entire
know,
market?
different companies are doing different things. Um, I've only run into it with new properties. So for example, I have a bunch of clients actually have houses in or not Hood River, um, Sun River. And I have another client who wanted to add a house in Sun River. And the new one we weren't able to add, but the old ones were not a problem. So if you've already got it, you've already got the insurance. They may never ask. They may never care. I see, as I say, because I haven't run into that. I've only run into that with new properties we're trying to get underwritten. But I would say um, I'd be prepared to remove brush, remove trees, do things that can mitigate risk. Um, I guess if I had a bunch of houses on Mount Hood, I'd probably call around to a bunch of insurance companies and see who would write it.
Yeah.
And if no one else would write it except my current carrier, I'd be nervous, honestly. Because that seems to be the problem, is the shrinkage of people who want to write it, who want to write the new business. That's what
Gotcha.
I'm seeing.
In Christy, it's tough because like we run into a lot of clients like you who have, one general area. They have a handful of properties, but they're kind of smattered around. And maybe we can write two or three of them, and the other ones are declined, or we can write all but one, right? So, like I was just dealing with a client in Gatlinburg, Tennessee, which is one of the very few. Like I remember, I said actuaries rarely get it wrong. That was one area we got wrong back in 2017. I could write all five of his properties except for one, and it's because that one property, the backyard fence is up against the national park, and national parks have a let it burn rule. And so the carrier they don't like that. You go, well, there's no way, if that catches on fire, there's no protection. So, yeah, definitely to Jeff's point, call around, get multiple quotes, see who can write what and where. You might have to kind of patch and piece together, based on where house A is over here and house B is over there. One company's writing that, the other, they're not writing it over there. That's going to be a little bit of a struggle.
Yeah.
And Christy, I'll just add, as an actuary, I know from personal anecdotal experience looking for insurance for my own home, sometimes it can feel personal, but being an actuary and working in this space, these decisions are not made on a particular insured basis. It's looking at the entire book of business and all the claims data and exposure data that we have available, and drawing conclusions on that basis, as well as modeling and whatnot that Nick mentioned earlier, but trying to understand what particular characteristics make a property more or less risky from a
Gotcha.
loss perspective.
Thank you.
I I had a question. Can you hear me?
Mm-hmm.
Oh, okay.
Yeah.
When you talked about the condos in Portland, or more like multi-units, those insurance rates going up or more than, what is that about?
The short version is the industry's lost money on those. I don't know specifically why, but the appetite for apartments and condos has gone down greatly, and the premiums are going up. And I wish I knew. I mean, other than
Which
just
makes the appetite go down more.
yeah,
Yeah.
I'm actually a realtor in Portland, and I list a lot of condos in the Pearl District, and it's just rough, and insurance is a big piece of it.
sure,
I mean, add that to the whole HOA piece, and people are having a hard time affording it.
It's
yeah,
back to water damage. Like that's our big thing with us, with our business. Like if there's water damage in a condo that we insure, it's probably only going to be $5,000 to $10,000. The problem is now we have 20, 30, 40, 50, $100,000 in water damage to neighboring units below them. And now this has turned into a liability claim. Right. So it's not like a single family home where $10,000 in water damage is $10,000 in water damage. Now we're talking potentially hundreds of thousands of dollars on the losses from the condos. And as condos are rarely updated as frequently in our experience as a single family home is. And so some of these condo buildings are really kind of aging a lot. That's a big problem in Florida right now. these condos are just old and they're kind of falling apart. They've been battered and beaten by these storms, and it's creating an issue on the insurance side. But like in the Portland, like for us with Portland, for example, or Seattle or any other large metro, we've been fairly stable with our condo rate, but our condo rate started really high to begin with because of those problems, right? So we're like steadily might come in on a condo at like $600-700 a year. Like I've been pretty flat for the last decade at like $1,500 a year. It's just where our rates are. So we've kind of priced that into our model. But I can see the rest of the retail market getting close to us or closer with these big $100,000+ losses from one toilet leak. It's rough.
Mm-hmm. Makes sense.
Yeah.
Yeah.
Thank you.
I have a question. Can you hear me?
Yep.
Well, okay. I just recently converted my single family home into a combination short-term rental on the main floor and midterm rental in the basement. They're both fully stocked apartments. I used to live at different times in my life with that house. I used to live in each area. I recently moved out of there and have those two rental situations established, and I'm in an ADU in my daughter's backyard. So my insurance for the house has not changed over the last several years. And when I first got that insurance, it was kind of a loosely answered when I asked about what it should be with the rental situations, is that at one time, one or the other of that has always had a tenant. And they said, well, if you're following the rules in Portland, then we'll cover you. That's the way it is. But that's been now several years. So what I have is that same insurance, and I've got quake coverage, and I have an umbrella. And now with that changing situation, I'm seeing that probably I need to have that insurance evaluated and then get some rental coverage for myself in my new situation. So I have two questions. One is shall I look for somebody who will cover all of those buckets at the same time? And then in terms of the potential damage from that single family dwelling yard, I have personally taken down 2 conifers because they seemed a little dangerous to me and the neighbors wanted them down. I have a deciduous tree that I get complaints from the neighbors because it's large, and that has not come down. And one of the difficulties is that the city of Portland really wants you to hang on to your trees. They just do. And so you got to fight that battle if you're going to worry about the climate, the potential damage to neighbors, all of that. And then the other thing to add to that is that last year I did have a claim because my last conifer tree came down and I had some damage in that regard. So
was the damage from the tree to your house or a neighbor's house?
The damage was not to my house, but to a shed and part of the fence and things like that. And now I did not offer, I didn't pay for the other people's damage because they had their own homeowners.
Yeah, gotcha. So every carrier is going to be a little bit different from the claim standpoint. Like I know internally with us, like that's probably a fairly small claim. Like we would probably honor a no claim credit. Other companies might not. So there may be an increase, and then they have everybody does a little bit different on their look back. I think most industry standard right now is about 3 years. Some companies look back 5 years on claims history. So you have to navigate that, Nancy. It's like, I know with us, it's not a big deal. Like I'm hearing what you have going on. It's like, man, this fits what we do perfectly. I know it fits all of our business, who we work for as well. So I just want to just kind of hit just from an advisement standpoint. Let me start with you're living in your daughter's ADU, you need an HO4 renter's insurance policy. If you don't already have that, you need to go get that. Any personal liability umbrellas that you have in place, you need to keep those in place because renter's insurance has very low liability limits. So you want to make sure you have that umbrella to give you more coverage, right? When it comes to your single family home with mixed use, that's where you may or may not be able to use the same company to insure that. Because the company you use for your home, your auto, and your renter's insurance, they may not like the duality of the rental exposure. They may very clearly define midterm rentals as a traditional landlord situation. That's fine. But they might view your short-term rental occupancy as a business. And then you can run into declinations and denials due to a business activity exclusion and that kind of standard market policy. So I would advise when it comes to your, let's separate two buckets, personal, and let's separate the other one into rental or business. Personal, get your auto insurance, your personal umbrella, and your renter's insurance from the same person. That's easy, simple, get it done. And then from this other facet, you have a unique exposure that not everybody has with two different occupancy types, with two different types of things, with two different types of risk analysis. So that's where you want to go to maybe investigate a specialty company and the opportunities that they present in risk management for having the two of those. What if somebody squats? What if there's bed bugs? What if one tenant at the midterm rental and the long-term or the short-term rental get in conflict with each other, right? What if this, what if that? What if one half of my building is shut down because of a claim, but not my other half? Like, how do we navigate this stuff? So I do think it would be important to investigate more specialty options around that particular building because you have two different types of occupancy going on.
Okay, it's a lot. I don't know exactly what, but I'll get some advice. So thank you.
I know any of us in our teams would be happy to talk with you and break this down for you, and just take it step by step. I just word vomited a lot of stuff. I get that, but my professional opinion, when you have mixed exposure like that, you kind of want to avoid the traditional retail markets as much as possible.
Okay.
Okay.
And then keep those other extras that I have and maybe add my rental insurance there.
Yeah, absolutely. Yeah, the retail market, what you got going on there on the personal side, and even Allstate, Nationwide, I mean, you name it, probably Jeff Dorn too, with Countrywide, they could do all that. And then, I know Jeff could also look at the multi-unit exposure that you have, right? So you might be able to get everything in one bucket, but you really just don't want to be like, well, my auto and my umbrellas with State Farm, so I'm going to put my multi-use mixed exposure rental structure with State Farm. You're probably not going to get what you're looking for in an overall package to protect your investment there in that market.
All right, thanks.
I would say, like I said before, you gotta talk to the agent because we would write every bit of that. We wouldn't have any issue with any of that. Some carriers probably would, but we wouldn't. So you'd have to talk to different agents and explain your situation and see if it's something they would write. It's like Nick says, some won't, some will, we would.
Okay,
So
thanks.
yeah, so do your call around.
Yeah, like I won't write your auto insurance. It's just not what we do. And so you could patch it together, or if Jeff Doran could do the whole package, it's really good to just shop everything right there at one spot.
How important is it to have face-to-face versus somebody who's elsewhere and you're dealing with everything over the phone?
I mean, I'm biased in the fact I'm in Montana and I can't talk to everybody face to face, but I do cherish face to face relationships in this business, especially in my prior life, if you want to call it that. I'm still pretty young, but I sold life insurance and did estate planning. It's really important to sit at a table with somebody. And so that just comes down to how you want to do business, Nancy. If you got somebody you can go and sit down and they can put it right in front of you. We do our very best at my company to try and do that over the phone and via email and video conference if you'd like to do that. Show you pictures, highlight things, really point out where maybe some gaps or misses in contracts are. But I think we can get business and education across in the digital world very well these days. But again, if that's not if you cherish that face-to-face relationship, definitely find somebody you can go and sit down in their office and talk to them.
Okay, thanks. I appreciate it.
I have to run, but thank you for allowing me to participate. And yeah, you got a lot of talent on this board, so I'm sure your questions will get answered. But
Yeah, thank you so much, Jeff. I
all
really
right,
appreciate you joining in. You
for
have a
sure.
great day, and I'll start to wrap it up for the rest of us as well. Thanks.
Thank you.
So yeah, wow. I don't know about you guys, but I learned a lot today. And I learned kind of some things I need to check out and make sure they've got coverage for adequately. We had some really good insights from our whole panel, and I really appreciate all of you